Distinguish between market value and intrinsic value. Market value is the price at which an asset can be bought and sold. Liquid equity securities that trade on the New York Stock Exchange, for example, have changing market values throughout the day. Intrinsic value, also called fundamental value, is the value placed on an asset by investors if they had a complete understanding of that asset's investment characteristics. Intrinsic value can only be estimated due to a large number of factors affecting its value. For example, a bond's intrinsic value is dependent on knowing the future of interest rates, principal value, timing of payments, understanding of default risk, liquidity of market, and term structure of interest rates, among many different factors. Market prices are typically accepted by investors as accurately reflecting intrinsic values if the markets are highly efficient. Differences in perceived intrinsic value and market value are the basis for active portfolio management. If a portfolio manager can identify and buy an asset whose market value is below its intrinsic value, he will stand to profit. If investors believe that markets are relatively inefficient, they may try to develop an independent estimate of intrinsic value. There are a number of theories and models used to estimate intrinsic value, but all require some form of judgment. The more complex an asset's future cash flows, the more difficult it is to estimate intrinsic value. Market values simply represent the point where supply and demand, or sellers and buyers, meet. As new information flows to buyers and sellers, perceived intrinsic values change, and, hence, market values also change.